Is it time to put your money under the mattress, or is it time to make it work? Former White House advisor Todd Buchholz and Chief Investment Officer of Allan Gray, Andrew Lapping, are here to discuss. Todd, can you sum up the global context for us at the moment? And can you discuss the biggest game changers that you think are going to impact the investment horizon over the next decade?
Well, currently the world economy is stitching itself together rather slowly, but for the first time in quite a few years, we've got a world economy that's growing. There are risks ahead, political risks. You've got mature countries in the US and Europe that are aging rather quickly. And at the same time, you've got revolutionary changes in energy markets and new sources of supply that I think will help keep down inflation over the next 5 to 10 years.
Andrew, what does this picture that Todd has painted mean from your perspective?
It's about separating the economic outlook and current situation from valuation. So people have now realized that the economy is beginning to recover. You see that coming through in commodity prices quite strongly. Certain equity markets have performed very strongly, but that often means there's now less value. So in fact, the opportunities for us is when things are really going badly, people become very negative on economic or equity markets, and then you have lots of opportunities. So unfortunately, given the stellar returns in, say, the US market over the last 8 years, there are far less opportunities there. Fortunately, there are still some investing or equity opportunities in certain emerging markets, specific stocks around the world. But you must be very careful what you pick.
Todd, you've moved from the White House to academia. So what do you think are the biggest risks that global investors face right now?
You can't ignore the political risks in the world. A madman in North Korea has access to nuclear weapons. Vladimir Putin in Russia is not a madman, but he's a shrewd man and an ambitious person. You also have China, which is looking to extend its hegemony and control over Asia. So these are political risks. It's hard for investors simply to shrug them off. On the other hand, there are always political risks. And over the last few years, equity investors have seemed to ignore those risks and have poured money in with great enthusiasm into stock markets.
Andrew, what is your take on this, and how should South African investors be facing up to this?
So I agree with Todd that there are some very serious risks at the moment, and investors have not given them full weighting. But for us as investors, and it'll be interesting to see what Todd thinks about this, is one of the biggest risks is probably the potential unwind of fiscal stimulus. So you've got interest rates at zero across most of the world. In Europe, you've had the ECB buying bonds aggressively, i.e. printing money, similarly in Japan. And now suddenly you have a situation where labor markets seem to be tightening basically across the world. And you would think that would lead to inflationary pressure. And the big question now is how these central banks are going to unwind the fiscal stimulus and what that means for asset prices, whether that be bonds, equity, property. And I think it's going to be a very fine line they're going to have to tread.
And there is this question as to whether the markets and the economies can tolerate higher interest rates. If higher interest rates come, will the housing sector and the automobile sector remain strong as they have been in industrialized nations? Or are they so sensitive and so needing the subsidy of super low interest rates that they buckle if central banks start tightening? And it remains to be seen how that's going to work out.
So let's get into the nitty-gritty of it. So what asset classes look the most attractive to you right now?
When interest rates are nearly zero, it's hard to say that stuffing your money in a mattress makes sense. It's hard to say that bank CDs make sense. I think that commodity prices will be strengthening in the short term, but I think new extraction technologies and new supply side effects mean that that might be only a short-term effect. So I think one can bet on commodities now, but one ought to be prepared to pull that money back in a few months after a rally takes place.
Andrew, which asset classes are top of mind?
The whole idea with money printing is obviously to force people into assets, to force them out of cash. So sometimes that means cash is the right place to be to protect yourself from the downside risk. But I fully agree, you've got to be careful about the slow grind of inflation. But where we find value is some of the less loved places, certain emerging markets, whether that be Brazil, Korea, which they clearly risks of a crazy person just across the border. But then again, certain African markets, which are very out of favor. Things have been tough. And if commodity prices do take a bit of a bump, then African economies tend to be better. And I think we could see a big kicker there. But those are quite niche markets.
So let's end off with the $1 million question, which is now the time to invest? Todd?
It is always the time to invest. The question is where? There are no obvious places. There's never an easy win, or else the market will have already been there. So people need to be prudent, and they need to take advice from prudent people, which is why Andrew is here today.
So Andrew, give us your take on that.
I couldn't agree more. I mean, it's always the time.
Of course, I just complimented you. Of course you couldn't agree more.
And that is the case for most people. Most people are saving consistently over time. They mustn't try and time the markets, time assets. They must stick to their strategy, continue to invest, and do so prudently, and select asset managers whose philosophy and ideas make sense to them, and stick with that asset manager over the long term.
And there you have it. Continue to invest and stick with your plan. Thank you so much for joining us today.
Thanks, Jessica.
Thank you.